Hello, in this lecture we're going to continue on chapter 25 with managerial decision making. We're going to continue with some types of decisions that are fairly common and types of decisions that will demonstrate some of the larger decision making processes that we want to incorporate, which is to take a look at the incremental cost when making some of these large or uncommon types of decisions. We want to make the decision at the margin. So in this case we're going to take a look at make or buy decisions. Should we make something internally or should we buy it externally? And therefore, so we're going to start off with the incremental costs are important in decision to make a product or purchase it from a supplier. So what are the incremental costs? Those are the costs at the margin. Those are the costs from here forward that it would take in this decision. Those are the relevant items. So the cost to produce an item must include, remember, if we're manufacturing anything, the three components to manufacturing: direct labor, direct materials, and overhead. And as with many of our other decisions, the overhead is usually the one we're going to have to look into, because many times, for the most part, overhead is oftentimes fixed, meaning we're using an arbitrary allocation method to allocate the overhead in to a per unit method. Whereas the direct costs and the direct labor pretty much generally, for the most part, are variable in nature. Therefore, when we talk about the unit cost, we're usually thinking we're narrowing down on that overhead because it may be allocated arbitrarily and it may be basically fixed in nature. Therefore, the decision to make or buy in this case may not include part of that overhead. So we should not use the predetermined overhead application rate to determine product costs in the decision in that case. So make or buy. So we have Fast Track currently makes Part 417, assigning overhead at 100% of direct labor costs with the following units. So what does that mean? We're making this part and part of, we would assume, our total manufacturing process. So we have, if we're making, say, cars, and that's a part in our car, we can either buy that from an outside vendor or we can make it internally. Currently, if we're saying we're making it internally and we are assigning the overhead. What does that mean when we assign the overhead at 100 of direct labor? That has nothing to do with the actual direct labor that we are putting in there in terms of the overhead. Direct labor is going to be a separate calculation. What we are doing is using direct labor to estimate the amount of overhead. Remember, that's everything else, like depreciation on the factory, rent on the factory, all that kind of thing, that we're going to apply to a per unit and overhead basis. So if we look at the calculation then, to make it, if we took it a per unit cost to make part 417, then we would have the direct materials of 45 cents, direct labor of 50 cents, and then we applied the overhead based on basically the same number as the direct labor at a rate of 100% of direct labor at 50. Remember that that application is arbitrary in nature. We applied it, meaning that part of that overhead may be fixed in nature. If it were, then we should take it out because it should not be in part of our incremental decision making. So if we do an analysis such as this, we can say that from the supplier, Fast Track from a supplier has $1.80. Someone says that they will sell it to us for $1.20. Sorry, $1.20. $1.20 to buy the part, this part 417 that we currently make internally. And remember that we are currently saying that it costs $1.45. So the buyer thinks he's got a sale there, obviously, because they're saying, well, hey, look, I'll give it to you for $1.20, $1.20 per part. But when we reconsider the overhead, the question really is, well, the direct material and the direct labor are 45 and 50, and that would add up to the 95. Now, if all of that overhead that we had was fixed cost, which we would incur anyways in other areas, then it would not make sense for us to buy. We would still be producing because the real cost on the margin would only be 95 cents for us. If, on the other hand, part of those fixed costs would not be there because they're either variable or we would not need them, if we were to eliminate the producing of this particular part, then they would be relevant. So in this case, they would have to be fixed costs of at least 25 cents in order for us to think about buying rather than continuing to make internally, even though at this point in time we're saying that they are costing $1.45 with the allocation of that fixed cost overhead. All right, so let's take a look at another type of example that we could have. scrap or rework. Another common type of decision that we could have is whether to scrap the materials for items, say, that were not processed well. We know that when we go through the production process, we may have some items that did not pass inspection in this case. And therefore the question is, well, should we put them back through the process and do it again, or should we scrap it at that point in time? And as long as the rework costs are recovered through sale of the product and rework cost does not interfere with normal production, we should rework rather than scrap. So that's going to be the decision-making process. Should we put it back into production or not? So costs incurred in manufacturing units of product costs that do not meet qualifications are sunk and costs cannot be recovered. That means what we do not want to consider here is once the item has gone through the production process and we said it's not up to inspection, then the cost of us at that point in time of us producing it the first time is sunk. We don't need to consider that at the point in time that it has been scrapped. It shouldn't be in our decision making. Should we make a decision as to whether we should increase the rate of products that are good and decrease the rate of products that are scrapped? That's a different decision to make. If we're going to say that this constant rate of faulty goods is at what it is, then the question is, should we rework them or should we scrap them at that time? So if we do that, we're going to make the decision at the margin using relevant costs, and we're going to say the example, they have 10,000 defective units that cost $1 each to make. So again, the $1 sunk, the units can be scrapped now for 40 cents. So we could sell them for 40 cents each at this point as scrapped units, or they can be reworked for 80 cents. So it would cost us 80 cents to work these into a usable unit that we could sell at a normal profit. If reworked, the units can be sold for the normal selling price of $1.50 each. Reworking the defective units will prevent the production of 10,000 new units that would also be sold for $1.50. What does that mean? It means that we're already at capacity before. So if we run these back through the production process in order to rework it, the opportunity cost will be that we're going to have to produce 10,000 less units that would be from scratch, the new units. So that's the question then. So now we're going to take that analysis and see what should Fast Track do. So we have the comparison then being the sale or scrap comparison. Here's the scrap. We sell them, we get $4,000. Why? Because we got 10,000 units. We could sell them at 40 at the scrapped price and just walk away at that point. Or we can rework them. At the end of the rework process, we can then sell them at full price, which would be the 10,000 units at $1.50, giving us 15,000. But there are, of course, costs for us to rework it. We've got the out-of-pocket costs, which is the costs that are pretty relevant and obvious to us most of the time. These are the costs that we would think of. And we have the 10,000 units times the direct material and the direct labor would give us 8,000 that would go into the rework process. That is, of course, less than the materials that would go into making it from scratch if we're going to make a new one. The thing that is less obvious that we need to take into consideration is the fact that we're going to have, in order for us to rework these, we have to forego the opportunity cost of making products that we could have made from scratch and sold at that $1.50. So that's the opportunity cost of not making the new products, which are 50 cents per unit in this case, or 5,000. That's the relevant cost that oftentimes can be overlooked within the calculation, and therefore we have the 2,000. So that means that the 4,000 is greater than the 2,000 if we take that into consideration. Therefore, we should go ahead and scrap and take the 4,000 at this point in time since it's higher than the 2,000. Okay, sell or process further, another common type of decision. A business are often faced with a decision to sell partial completed products as is, or to process them further and sell later. So as a general rule, we process further only if incremental revenues exceed incremental costs. So just as normal decision making, we're going to make the decision at the margin. We're going to say, should we stop the process here, or should we refine it further? If we refine it further, we can of course sell it generally at a higher rate. That's the only reason we would do it. But we're going to of course have the cost of processing further. So example, we have 40,000 units of partially finished Q units. Processing costs to date are 30,000. The 40,000 unfinished units can be sold as is for $50,000, or they can be processed further to produce finished products X, Y, and Z. Processing the units further will cost an additional 80,000, but we'll get revenue of 100,000 at that time. So let's take a look at analysis. What should Fast Track do? And if we break this down, it's fairly small analysis. And it's not. We're going to say the sell as of Q. If we sell it at the break-off point, remember that's where we're making the decision. We're not really considering the 30,000 before. It's sunk as of the margin, as of the decision-making point that we are thinking of. As of this point in time, we could sell it for $50,000, which means we would get income of $50,000, or we could process further and sell it at the end of the day for $150,000 in the form of products X, Y, and Z rather than product Q, because we have processed it into X, Y, and Z. But the incremental costs at the margin from that point forward would be $80,000 more dollars in order to process further. Therefore, the 150 minus the 70, minus the 80 would be 70, and that would be higher than the 50. Therefore, the processing further in this case would be the way to go. So Fast Track should process further. Note that the 30,000 previously incurred costs are excluded from the analysis. These costs are sunk. So all the costs before the time in which we're making the decision are not relevant to the decision.